The Affordable Care Act's employer shared responsibility rules are also known as the pay or play rules. These rules impose penalties on some employers that do not offer health coverage to their full-time employees and dependents. To avoid penalties, the coverage must be affordable and provide minimum value. Penalties are triggered if a full-time employee receives a subsidy for coverage purchased through a health insurance marketplace. The employer shared responsibility rules apply only to applicable large employers, or ALEs. These are employers with an average of 50 or more full-time and full-time equivalent employees during the prior calendar year. Full-time employees are those working an average of 30 or more hours per week, or 130 hours in a calendar month. The number of full-time equivalents is calculated based on the hours of part-time employees. Coverage is affordable if the employee's cost for self-only coverage does not exceed 9.5% of his or her income. This percentage is generally adjusted for inflation each year. The adjustments began with the 2015 calendar year. There are 3 affordability safe harbors that allow an employer to measure affordability based on the employee's W-2 wages, the employee's rate of pay, or the federal poverty level, FPL. These safe harbors are optional, but can help ALEs make prospective decisions about health plan costs and contributions and assess possible penalty exposure. A plan provides minimum value if it pays at least 60% of the costs of benefits on average and covers inpatient hospitalization services and physician services. There are 4 ways an employer can show that its plan provides minimum value: using the minimum value calculator provided by the federal government, satisfying one of 3 safe harbor plan design options, obtaining a certification from an actuary, or providing a small group bronze, silver, gold, or platinum plan. The employer shared responsibility payment is a tax penalty to ensure that companies who choose not to provide health care for their workers are still paying into the healthcare system. A payment is triggered if an ALE's full-time employee receives a marketplace subsidy. The annual penalty for ALEs that do not offer coverage to substantially all, or 95%, of their full-time employees is $2,000 per full-time employee, minus the first 30 full-time employees. For ALEs that do not offer coverage to all full-time employees, or whose coverage does not meet affordability or minimum value standards, the annual penalty is $3,000 for each full-time employee receiving a subsidy. The $2,000 and $3,000 penalty amounts are also adjusted each year for inflation. Some employers have chosen to pay the employer shared responsibility penalty rather than offer health coverage to their employees. However, most employers are continuing to offer health coverage and other benefits as a way to recruit and retain quality employees. Whatever choice they make, large employers should assess how they might be affected by the pay or play rules. For more information regarding the ACA's pay or play rules, contact your broker.